In this video, we're going to discuss some limitations on the dividends received deduction. So let's start with the income limitations. If we have a company called Cliff Camping Incorporated that owns 10% of another company called Myra's Camping Gear, so normally because they own 10%, they would be entitled to a 50% dividend received deduction on any dividends that they receive from Myra's Camping Gear. Okay, so let's say that Myra's Camping Gear issued a $200,000 cash dividend to Cliff Camping. So if we have a $200,000 dividend, then 50% deduction would lead to a $100,000 tax deduction for Cliff Camping Incorporated. But the income limitation works as follows. We say, okay, let's take the taxable income of the company receiving the dividends, and then and that's before accounting for any net operating losses, capital loss carrybacks, or the dividend received deduction itself. We'll take the taxable income there, so that's $100,000, and we'll multiply that by the 50%. And if that amount is less, and in this case it's $50,000. If it's less than the dividend received deduction, then this is going to be the dividend received deduction. So basically we're saying, look, normally dividend received deduction would be $100,000, but in this case the income times the percentage for the dividend received deduction would yield an amount that is less than the normal dividend received deduction. So this becomes the dividend received deduction, $50,000. And so if you own if Cliff Camping owned 35% ownership instead of 10, if it owned 35% of Myra's Camping Gear, then we do the same thing, but only we would use 65% here and here. We would take 200,000 times 65, which would be 130,000. That would be the normal dividend received deduction. But then we'd say, well, we've got 100,000 in taxable income times 65%. That would be $65,000. So then the dividend received deduction wouldn't be the 130, it would be the 65. Now, if you owned more 80% or more, if Cliff Camping, so instead of 35, let's say they own 90%, then the limitation doesn't apply in terms of income. You just get the 100%. So if there's $200,000 dividend, then Cliff Camping will get a $200,000 dividend received deduction. Now, beyond these income limitations, the dividend received deduction does not apply to preferred stock. So we're only talking about common stock here, dividends on common stock. So no preferred stock. And then dividends from stock that was purchased with borrowed money. So what the IRS is trying, or what the tax code is trying to do here is saying, look, if you borrow money, you're going to get a tax deduction for the interest. You're going to get a tax deduction for the interest. And so we don't want to give you a tax deduction for the interest and then turn around and also give you a dividend received deduction. So if you're borrowing money to buy the stock and then you receive dividends, we're not going to give you that double benefit. You're already getting a tax deduction for the interest, so that's sufficient. Also, if stock was owned less than 46 days out of the 91-day window surrounding the ex-dividend date, so then you would not be able to get the, so let me lay this out. This is actually kind of complicated. So let's say that a company's ex-dividend date is March 15th. And March 15th, when I say ex-dividend date, it's the date after which when a company announced that, oh, we're going to issue a dividend to all their shareholders. Well, the ex-dividend date is the date where after that date, anyone holding the stock they're not entitled to a dividend. So if the ex-dividend date is March 15th, on March 16th, if you're holding the stock, you don't get a dividend. If you just bought it for the first time on March 16th. Okay, so it's anybody March 15th or before, there'll be a certain window. Now, it's saying this. So right here, 45 days before, so let's say this is 45 days before, and then 45 days after. So that if you take that, so take March 15th and then plus 45 days after, and then plus the 45 days before, that's 91 days. That's what I'm talking about, the 91-day window. So if we take this entire window of time of 91 days, and if you own the stock less than 46 days out of this entire 91-day window, then you're not entitled to a dividend received deduction. And the purpose there is they don't want the tax code is written in such a way so you don't buy the stock on March 14th, for example, and then get the dividend and then get the dividend received deduction and then turn around and maybe sell the stock on March 16th when the stock price is probably going to go down, because after the ex-dividend date, I mean, the stock just, there was just a dividend issued. So the day after, the stock's probably going to drop a bit, the price. And so if you then turned around and sold the stock on March 16th, you'd have a capital loss. So you'd have a capital loss, and you would have gotten the dividend received deduction. So this is to avoid people from, or corporations from, gaming the system in that way. And then also, and this goes back to the heart of the dividend received deduction, entities other than the C corporations, for example, an S corporation, they're not entitled to get the dividend received deduction. It's for C corporations, and again, it's because the whole purpose of the dividend received deduction is to avoid the possibility of triple taxation. When we had our example with Myra's Camping Gear, so if Myra's Camping Gear gets taxed on its income, and then we have Cliff Camping gets taxed on the income, assuming there was no dividend received deduction. And then Cliff Camping issues a dividend to its shareholder, who then gets taxed on the dividend received. Then we would have 3 layers of taxation. And so we don't have that issue with an S corporation, because S corporations aren't subject to, it's a flow-through entity. It's not subject to multiple layers of taxation. So basically, the dividend received deduction is to provide tax relief for C corporations to avoid this triple taxation scenario.